Hello, my name's Alex Brandreth, Chief Investment Officer at Luna Investment Management. I'm joined today by Seldian Curri, Deputy Portfolio Manager. But today, the both of us are going to go through what happened in the first quarter and provide a bit of an outlook. Certainly been an interesting quarter. I think we could say that pretty much since Donald Trump took office a year or so ago. Obviously the main topic of conversation today is the ongoing conflict in the Middle East. And that's exactly where we're going to start today. So, from a logical perspective, you could say that the most obvious decision was that there be a de-escalation on both sides. It's in nobody's interest for this to keep rumbling on. Firstly, from a humanitarian perspective, but equally from an economic perspective as well. Now, one of Iran's biggest outputs and impact on the economy is oil and natural gas. And the longer the Straits of Hormuz are closed, then the bigger the economic impact is going to be on Iran. And clearly, as we know, there's economic consequences on developed markets as well in terms of the Straits of Hormuz being closed. So it's clearly a very volatile, intense situation, but common sense would suggest that it should come to an end. But as we put here, humility is required, and sometimes common sense does go out the window. As we saw when Russia invaded Ukraine, the first impact that happens here is the commodity impact, and we've already seen that happen. The oil price has spiked, it's come through in terms of prices at the petrol pump, and the longer this goes on, the bigger the impact that will be. And inflation being higher is a tax to growth because you've got less money in your pocket to go out and spend. So it does mean that economic growth has been reduced, and that the World Bank came out with some statistics a week or so ago and said that the UK economic growth is going to be impacted by about 0.5% this year on the back of the developments that we've seen. So there's a clear impact already coming through in terms of both inflation and economic growth. As we have seen numerous times over the years when conflicts like this start, markets move and react very quickly. As was touched on, or Seldian will touch on, the market reaction in the first quarter, particularly in March, was significant, and they moved very quickly in a very short period of time. What we always say, and I apologise if you've seen this before and you've heard me say it a million times, but I'll say it again, is do not overreact to short-term news. We saw this in COVID, we saw this in the financial crisis, we saw this when Russia invaded Ukraine. Companies adapt, people adapt, countries adapt to the situation and the environment that we're in. And you could say that we had an oil price shock 4 years ago when Russia invaded Ukraine, but just before this happened, markets were at all-time high levels, and that conflict is still going on. Excuse me. So it's important not to overreact in the short term and focus on what your goals are. Most of our clients and everyone that we speak to say that they're investing for the long term. Focus on that long term investment goal and do not try to get suckered into what's going on in the short term with the headlines in the news, because things can be volatile in both directions. As we've seen more recently, you have the negative news of the war starting, but then you have the potential of a ceasefire and markets bounce back quickly. So why does this matter? And I've mentioned the Straits of Hormuz a few times already. It's because of around 20% of natural gas and oil that the world produces, it goes through there on a daily basis. And it's not just that, it has impact on other commodities like fertilizer as well. So it's important that the Straits of Hormuz is open because it's going to impact commodity prices. This is what's happened to the oil price. This is looking at 5 years, and we purposely done this because it includes the Russia invasion in Ukraine. You can see that the oil price spiked to over $125 a barrel. And then after the war, after the war started, you can see that oil price trended lower, and we got to around $60 just before the conflict started. You can see how quickly financial markets price in the news. The oil price spiked very quickly to over $110. But as you can see more recently, it has been easing and coming off and is around $100 per barrel at the moment. What does that mean? I've already touched on the fact that inflation is going to be higher and economic growth is going to be weaker. Well, that's a nightmare for central banks because that's stagflation. You've got inflation and prices increasing, and you've got your economy weakening. And one of the things that we were saying at the beginning of the year is we were very optimistic coming into this year because you'd see interest rates coming down in most global economies. That's gone off the table, we think, now for the UK. So just to explain this chart here, this goes back to January of last year. It looks at what the expectation was for December 2026 interest rates. So what were people expecting over a year ago for interest rates to be at Christmas this year? And you can see that as we start at the beginning of this chart, it starts around 4%, which is where interest rates were at the time. As inflation came down and interest rates were cut through the course of last year, the expectation was that interest rates would be around 3.25 just before the conflict. We've put a big red box around where we are today. The interest rate today is at 3.75. So before the conflict started, the market was expecting 2 interest rate cuts this year. After the conflict started, you can see how that line spikes, and it spikes significantly to just around 4.5%. So then it went from an expectation that interest rates would be cut 2 times to expectations that interest rates would be increased 3 times. So quite the shift in the short term in the UK in terms of interest rate expectations. More recently, you can see that started to moderate, and the expectation now is around 4%. So the expectation is that interest rates will increase by 1 time by December. I don't think that will happen. I think this is going to be a short-term conflict for the reasons that I mentioned earlier. So it could be a good opportunity to buy shorter-dated bonds, which are sold off on the back of these expectations. I'm going to hand over to Seldian now, and he's going to talk through the equity and bond markets and the impact that we saw in the first quarter.
Thank you. Hi. So global equity markets, they delivered a mixed picture over the quarter with sharp divergences between geographies. Given the significant weight in energy and materials, in the UK equities were a relative bright spot in the quarter, with FTSE All-Share returning positive 2.4% in sterling terms, while the Nikkei, the Japanese index, staged a dramatic rally mid-quarter. It reversed sharply and ending up 2.7%, also in sterling terms. On the other hand, US technology were a significant laggard, with Nasdaq falling 4% in the quarter, and also the broader index S&P 500 falling 2.4%. This reflecting the sentiment around valuations and the macro outlook weighing on US markets. Also, the European and Hong Kong indices, they also ended in red, with 2.3 and 1.76 down respectively. Fixed income offered little shelter after a brief rally through March, which saw gilts and UK corporate bonds post modest gains. That reversed quickly in March, leaving all major bond indices in red for the end of the quarter. Sterling gilts fell 2% and UK corporate bonds fell 2.1%. The sell-off reflecting renewed pressure on yields. Other more defensively positioned strategies, also including strategic bond and global emerging markets bond, fell slightly less than 1% for the quarter. It's worth noting that since the end of the quarter, markets have reacted to the ceasefire in the Middle East, and markets have rebounded significantly.
Perfect. Yeah, no, thank you, Seldian. That's been really helpful in terms of insight into where we've been. That's a quarter. As I've said right at the beginning, I think the most important thing to focus on is longer term investment decisions, and that's what we do. That's what we've been talking about at the desk and the team when we've been going through this over the last few months. And this chart here, I think, highlights it pretty well. So you go all the way back to the 1970s, you look at the different periods of oil crises that we've been through, the Arab oil embargo, Iranian revolution, the first Gulf War, etc. And you can see, despite the fact that we've had these events that have impacted us, the S&P 500, has gone on to deliver strong total returns during that time period. And this is probably my favourite chart, and you know, you're sad when you have favourite charts. I recently heard it was called the measles chart because of the red dots. But just to explain this, it goes back to 1986. It shows the MSCI World Index. The red dots represent the intra-year decline that we saw during that year, and the grey bars say, well, what happened during that year? And I think the first thing to point out is there's red dots every year. We always have a drawdown, there's always a market event, there's always an impact that comes through, which means stock markets have a bad run for a period of time. And this year's been pretty average, to be honest. The average, the median decline that we see is 10%. We're at 8% already. The grey bars tend to be positive 3/4 of the time. You tend to see stock markets positive 75% of the time and down only 1/4 of the time. So what we're going through at the moment is very normal. And just taking a step back then, look, as we touched on, the conflict has had an upward impact on inflation. I think we've already noticed that already, and that does have a negative impact on growth. The important point here, though, is we aren't going into recession. It's still expected that the global economy is going to grow this year. The UK economy is still going to grow, it's just not going to grow as much. The longer this goes on, the worse it is most importantly from a humanitarian perspective, as touched on, but the bigger the impact is going to be in terms of inflation, the bigger the impact is going to be on the economy. So something to keep an eye on, and it's, you know, the headlines are swinging each way every single day. As we came into this year, I've already mentioned we were expecting interest rates to come down. That would have been stimulative for the UK economy this year. That means that people are going to go out and spend more because they're getting less on interest. It means that debt finance is cheaper, so it would have been a positive for the economy. So that's off the table. We're expecting 2 interest rate cuts, and now, we're expecting none this year. The market's pricing in 1 interest rate rise. We'll wait and see what happens. Sorry, that's to December, at the end of the year. As Seldian touched on, it was a very difficult March after a very strong January and February for both bond and equity markets. The conflict really impacted markets in March. And as Seldian mentioned as well, April so far has been a little bit better in terms of the ceasefire coming through. Markets have had a relief rally there. We see it all the time. Short-term noise does impact markets very quickly. And sometimes when you're going through this, it's difficult to know what the outcome is going to be. But markets tend to react, people adapt, and over the long term, which is why we're investing, tends to be a good time to be invested. And as we've said, I mean, I've had a lot of clients say to me, this is different this time, it's not different this time. We've had numerous conflicts over the years in different forms. It's obviously not very nice when it's happening and it causes concerns. But it's nothing new. We've seen similar bouts of volatility in the past and we've rode through them. What I would say, and I would always encourage you, if you've got any concerns or you want to speak to anyone or you want any more information about what we're doing or how we're managing your portfolio during this time, then please feel free to reach out to either myself or one of the members of the Luna team. And that's it. We can't have time for questions today because it's recording, but just wanted to thank you for listening today. As I mentioned, if you do have any questions or you want to speak to someone, then please feel free to contact a member of the Luna team. Thank you.